The day after the Federal Reserve came in with those emergency measures, really historic measures, three messages from the markets. One, it wasn't enough. Second, it did have some modest effect. And third, the Fed needs to do more, likely in the commercial paper market. A couple of things happened. The Fed encouraged overnight banks to use the discount window, and the banks did come together, 8 of them, and did, in fact, use it to encourage others. This is something that's had a stigma for a long time, where if a bank access the discount window, there was concern about its solvency, so they all got together with the Fed's encouragement and went to the window, apparently, I do not know in how much size, but try to remove that stigma. Now, the Fed also yesterday did an unscheduled $500 billion repo operation in the afternoon. Not a lot of take-up on it. In fact, relative to what the Fed offered, there was $129 billion taken up in the morning and $19 billion in the afternoon. The Fed also bought $40 billion of treasuries as part of its $700 billion of purchases it said it was going to make. All of that, according to Medley, says the Fed operations are beginning to have an effect. For example, overnight, repo spike normalized, Treasury swap spread forward narrowed, 30-year Treasury notes bid-ask spreads tightened. That's pretty good news, but it's not enough, according to people. Morgan Stanley writing this morning, and I just got to make this a little bigger here, economic activity is contracting, and we see GDP posting a significant drop in second quarter. Monetary and fiscal policy support have been provided, and more is coming. It is not yet enough to calm financial market unrest. Guys, I think there's a couple ways to think about this. The first is that you have an unexpected shock to the economy, and so existing trades out there need to be unwound and weren't profitable and didn't have the right risk profile. And then you have this new thing come along with this new risk, and the question is, it's like a hot potato in the economy. Who's going to hold the risk as we get from here to there? Some people are not going to be able to pay their mortgage. That's going to have an effect on the mortgage debt that's out there. Some companies won't be able to pay their loans out there. That'll have an effect on corporate debt. So who will hold it? The Wall Street Journal has an interesting editorial this morning asking a basic question. Where will the liquidity come to get us from here to there? That's precisely what the market that we've been following, the internal machinations, the internal plumbing of the financial system, is trying to figure out. And it's a hot potato, and every day it seems to move from here to there. I guess I'm tossing back to Joe or Becky or Andrew or somebody somewhere.